Here again talking about demand and supply. Today I wanted to talk about inflation, mortgage rates, and Fed funds rates, since they just increased the Fed funds by a 0.25% on Wednesday. So on the screen here I have the inflation rate going back 10 years. Shows that it's hit 10 years or a little below a few times, goes up, moderates, and then obviously COVID, inflation dropped, and now it's taken off. As we've all heard, things are more and more costly. But I wanted to relate that to mortgage rates at first, to see how back in 2015 inflation started going up through 18 and kind of moderated a little bit, and then obviously dipped, and to watch what the 30-year, we'll focus on the 30-year, so that's what most people get for their mortgage. So it's a long-term bond, long-term rates. So when we go back here to the 15 time period, see it's in the threes, might touch up to 4. As inflation starts heating up, you can see the rates start going up. Now we're into the 4s, into 17, and then into 18, or squarely in the 4s. And then 19, you can see it starts to drop back down. So this is still before COVID. Go back to the inflation. You can see it. Inflation steadily was going up. So that is saying that things in the future will be more expensive. So that's why mortgage rates on the 30-year will go up. And then here as we get into 19, it kind of moderates, comes down. That would be why the mortgage rates start to fall down. And then obviously we hit COVID. So that dropped inflation back down to that 0 level. And since then, it's kind of been going up. As we've seen here, end of 19 comes down, 20, inflation goes to 0, rates drop to 0, as we all saw in 2021, stayed low until we started getting these inflation numbers started coming up in this time frame here. And now, we're getting back up there. It's following that inflation. So one thing that has definitely lagged is comparing this to the Fed funds. So here's historical Fed funds. It was at 0 for a really long time. And then as inflation started going up, the Fed was a little quicker to start increasing the Fed funds rate. And that's to help inflation, to try to moderate it on short term, have people keep their money in the banks short term and to not spend it. And you can see how that kind of kept inflation in check. It went up, and then it kind of stayed in the same area. So with the Fed funds doing that, it helped. And so they were a little delayed here after COVID. Obviously, they dropped it, back down to 0 and kept it, but probably should have been increasing it sooner than they have. So it'll be interesting how it goes forward, but it's definitely not a 1-to-1 ratio. But hopefully it'll help moderate the rates, the long-term rates here, as if they can control inflation. But again, I see inflation more driving the mortgage rates rather than the Fed increasing their rates. The Fed is trying to chase the inflation, get it to moderate, where inflation is what pushes stuff in the future to be more expensive, which relates to 30-year mortgages. If you find this helpful or have any questions, make a comment below, and I'll talk to you guys next time.